Good morning, everyone. Good morning, everyone. Today is Monday, May 12th, 2025. It is so very good to see you all this beautiful Monday morning. Here in Austin, Texas, we're going to be doing our Monday morning touch point where we update the new listing to pending ratio. Take a look at inventory. Let us see what is going on with inventory in the entire Austin area MLS. What's happening with pricing and how can we position ourselves this week for the amazing business of real estate? How can we equip our clients, empower our clients, and how can we ourselves be equipped and empowered? It is so good to see you all this Monday morning. Very important week this week. Lots going on in the economic calendar. Of course, this weekend, some major news that affects the market happened over the weekend, specifically a potential trade deal, a de-escalation in this trade war with China. And of course, you can see behind me what is happening with the bond market. Yields are up and the equity market is, of course, up. And it's going to be really interesting to see how the Fed is going to react to this news with potential tariff deals that are announced. So a lot going on. Of course, this week we have a lot that's happening right now with the economic calendar. We've got CPI, which is inflation. We've got PPI. There is a lot of stuff going on right now. So really a lot of stuff going on. So we're going to go ahead and just start updating the new listing to pending ratio so that we can see what's happening with inventory. And I'm really excited to do that. Okay, and so I just received a message right here in a private direct message. We've got, so I'm going to wait until the end of the meeting to address this. We're going to focus on the Monday morning touch point, and or I can just contact you offline and go over that. But I'll wait until the tail end of the meeting before we log off to address the question that was sent to me. So let's go ahead and just update the new listing to pending ratio, update all of the stats and see what is going on with the Austin market. And of course, you all know that the new listing to pending ratio is a very powerful and reliable leading market indicator that shows us the relation between properties that are entering the market and properties that are being absorbed by the market. Really quick 30-second recap. If the ratio is at exactly 1, we call that a perfect market equilibrium, meaning that exactly the same number of properties that are coming on the market are being absorbed by the market. If the ratio is under 1, that means that we have less properties being absorbed by the market, meaning going active under contract and pending in relation to the properties that are coming on the market through new listings and back on the market. So for example, if the ratio is 0.80, that means that 1,000 listings came on the market, 800 listings were absorbed by the market, and therefore over time inventory goes up. If the ratio conversely is over 1, let's say 1.2, that means that 1,000 listings came on the market and 1,200 listings were absorbed by the market. Therefore, over time, inventory will go down. Under the 1 ratio, we have some subcategories that we've identified. When the ratio is anywhere from that 0.65, I even say 0.7 to 0.85, that's going to give us a tangible increase in inventory. If the ratio is at a 0.75, that means that for every 10 properties that comes on the market, or let's just do 100, every 100 properties that come on the market, 75 are absorbed by the market, and therefore inventory goes up in a tangible way. That means that you've got 25% less properties that are being absorbed by the market in relation to the properties that are coming on the market. So think about it as demand is 25% less than the incoming inventory. Therefore, inventory will go up. If the ratio is under that 0.65, I'd say between 0.5 and 0.65, I classify that as a substantial increase in inventory. And let's just go ahead and use 0.5 as an example. That means that for every 2 properties entering the market, only 1 is going under contract. So you can see how inventory will go up at a substantial rate when you have a 50% absorption of new listings that are entering the market. For every 2 that come in the market, 1 goes under contract. That's going to give you a substantial increase in inventory. And you can see that we've been tracking this all the way back to January of 2000. And you can see that over the past few weeks, we've been in the blue. Blue means cold, red means hot. That's why we do a conditional format with this color code. Anytime you see blue, it's going to show you that's a little bit on the cooler side of things. What we're going to do before we update this week's data is we're going to go backwards in time over the past few weeks to see if we have to update anything based on activity that occurred with the pending, because we all know that agents, especially new construction, they can take a long time to update information. They can update the pendings for the next few weeks, and we're going to increase this one from 508 to 517. Then we're going to go from the 21st to the 28th. This is going to be 539. We're going to go from the 14th to the 21st. This is going to be 557. We're going to go from the 7th to the 14th. This is going to be 555. And you can see that we have to go backwards in time for a few weeks just so that we can capture all of the accurate information. There we have it. That's 660. We've updated all of the past. Now, I want to remind you that at 11:59 p.m. tonight, when we roll into midnight, all of the fields except for the pending will lock. The new, the price increase, the price drop, back on the market, active under contract, it locks in and it'll never change again. Whereas the pending information will change over the next few weeks as agents update the MLS. So when you access this resource tomorrow morning, you're going to see the latest and greatest new listings, price increase, price drop, and then keep on accessing this information so that you can see all the latest and greatest. So now we're going to update from the 5th all the way through the 12th. It is 10:07 a.m. Keep in mind, tomorrow morning, you're going to get the latest and greatest new listings, price increase, price drop. Well, let's go ahead and just pull up the new listings. Also want to remind you that this is for the 6-county area: Travis, Williamson, Bastrop, Hayes, Coldwell, and Burnett counties. We focus this data on the 6-county area, and we are looking at 1,378 new listings have entered the market so far until 10:08 a.m. I can expect, I'd say, another 100 to 125 new listings will enter the market between now and 11:59. That's going to put us right around the 1,500 new listing mark, slightly trailing the week before, which was a very high number at 1,554. Let's take a look at price increases. That number came down substantially. 2 weeks ago, 239. This week so far, 145. Let's take a look at price decreases. This is at 1686. Even though that number went down from the previous week, which was at 2104, take a look at this percentage. The percentage increase from 90% to 92%. What this is the price distribution, the price movement between price increase and price decrease. That means that out of anything and everything that could have gone up or down in price, 92% went down in price. Let's take a look at back on the market, see what's going on with this. We're at 188 back on the market. That number goes down from 241. We are at 14% back on the market. We just broke the previous trend over the past 3 weeks where the back on the market number was increasing a little bit. We're back down to 14% back on the market. And it is a little bit counterintuitive, but the lower the back in the market, the cooler the market, which means that buyers are able to negotiate more attractive offers on the front end. They're able to renegotiate during the option period or maybe after the appraisal. Sellers are more willing to give concessions to buyers. Buyers can spend time making a decision. They're more likely to hold on to that contract as opposed to a really crazy seller's market where buyers get cold feet. They feel like they overpaid. They feel like they didn't look at enough homes. They regret their decision. back on the market figures go up when the market is really strong, and it goes down when the market is more favored towards buyers. Let's take a look at active under contract. We are currently at 465 active under contract, trailing last week at 554, but once again, it's only 10:10 a.m. I would say that we can expect another 80 or so active under contract, which means we're really close to matching the previous week at 554. That's not a bad number. I'm not totally unhappy with that number, but this is where I need 5 people to go ahead and guess the number of pending transactions. What do you think over the past 5 days from May 5th all the way through May 12th? How many pending transactions? We've got Harold starting us off at 255. Let's get a few more guesses going. We've got 2 down, Seth at 289. We've got Rob coming in at a very bullish 378, 289 Melanie, Charmine at 240. And we've got Violet closing us off at 313. And the number comes in. It starts with a 2. It comes in at 285. 285, that is going to start us off at a 0.48 ratio. We know that that number is going to go up. It's going to go up a little bit. So, Seth, you came in very, very close. 285.48 ratio, meaning that less than half of less than half for every 2 properties that are coming on the market, 1 is going under contract. And you can see that that will cause a substantial increase in inventory. Really important for us to understand how this ratio impacts future market conditions. What do we expect to see over the next few weeks with this ratio still holding under that 0.65? We can expect more price drops. We are approaching 50% of the active listings on the market, and we're going to go over these charts here shortly, but close to 50% of the active listings that are currently on the market have already experienced price drops. More inventory means more pressure on pricing. Let's take a look at the week over week really quick. So we've already had a 5.9%, and this is the weekly year over year. So weekly year over year, same exact week last year. You can see that 2 weeks ago, we were up on new listings 12.7%, which is substantial. We are already up 5.9%. So if no new listings come on the market between 10:13 a.m. and 11:59 p.m. tonight, impossibility. We know that we're going to get about 100 to 125 new listings entering the market in the next 13 hours and 50 or 47 minutes. We know that that's going to happen, but we've already had a 5.9% increase. Where are we going to land? Somewhere around the 200 additional listings will come on the market this week compared to exactly the same week last year. But what about pendings? Well, we've been on the red in pendings going all the way back to April 7th. We had 2 weeks where we were positive, and this is going to be active under contract plus pending. We were positive by single-digit percentage from March 24th all the way through April 7th, and then we have to go all the way back to last year. If I were to count the number of cumulative pending listings, we are down roughly 2,000, meaning we've had roughly 2,000 less pendings so far year to date compared to the same period last year. On the new listing side of things, we're up by 1,900. So we're down by 2,000 on the pending. We're up by close to 2,000 on the new listings entering the market. And you can see what happens when you get that, an increase in inventory, increased months of inventory. We're going to talk about how months of inventory across the entire MLS is now at 6.1 months of inventory, and that's going to be the highest since August of 2021. I believe it was 5.3 months of inventory this month last year. We are now at 6.1 months of inventory. If we ever cross into the 7-month of inventory mark, that is going to be a overall buyer's market across the entire board. But we're going to look over some of this information here shortly. Let's go ahead and start updating the monthly information. First thing we're going to do is go back to April and see if we have to update this. Yes, we do. This is going to be 2019. April's new listing to pending ratio at a 0.62. We've got a question right here. Why do you think sellers are still listing given they know how slow the market is and how prices are coming down? That is a very good question, and let's address that. And I'm going to address that by putting people in 3 different categories. One of them is the overall market is going down, but you still have areas where the market is very healthy. You've got the what I call the recession-proof zip codes that still have 3.5 months of inventory. And you've got certain subdivisions where sellers are still getting multiple offers and even selling over list price. So it's very much back to that whole hyper-local market where certain areas, it's like, hey, seller, you're going to get the very best that you're ever going to get for this property. This is a very high demand area, demand driven market, and you're going to do very well in this area. So I will certainly put there are sellers in certain areas within town, within certain zip codes, where this is about as good of a time to sell as any other time, sometimes even the best time to sell based on their property, their location. I would also put a second category of sellers, which is they have to. They don't have a choice. They just got a job transfer. Certainly take my clients as an example. And many of our clients, it's, hey, I was relocated. We've had many clients get relocated out of the Austin area, and they're like, I don't care if this is a good or bad time for me to sell. I don't have a choice. I have to sell. I can't rent the property. I can't absorb the negative cash flow. I don't want to be a landlord. I just have to sell. I don't have a choice. And you also, I'm going to add a fourth category. You have a third category, and I'm certainly having these conversations with some non-team price agents where they don't know the reality of the market. You and I breathe this information. We go over it Monday, we go over it Wednesday, we go over it Friday. We're always talking about the market. And I am always shocked when I'm talking with other agents and we're just spitting out information. They're like, I had no idea. So you have sellers that are hiring agents that don't know the reality of the market within the zip code. And I love being a part of some of the Facebook groups because you can see agents posting like, I don't know what's going on. We just listed this amazing property and 2 weeks went by and I haven't had a showing, and I'll pull up the property and it's like, there's no way you're not going to get a showing. You can't give that property away. There's tons of inventory in that price point, in that square footage range. And you're overpriced by $50,000, but they don't have access to the information. Therefore, they pass on a completely different reality to their sellers. Their sellers are now acting on that completely different reality. And they're still going to list the property because they think we're back in the 2022 market, when in reality, that's just not the market. The fourth category is a seller that realizes, I know that my property went down by 10%. I'm selling a $400,000 property. I took a 10% loss on it. That means $40,000 loss. But I'm buying a $700,000 property that took a 15% loss on it. So I am taking $40,000 hit on the sale, but I'm picking up a $90,000 discount on the purchase. And we've had that discussion. I spoke with someone recently where that was their rationale. They're like, well, the property, yeah, I get it. I'm losing, quote unquote, on paper, losing money on the property that I'm selling, but I'm able to buy this other property that I've always wanted to buy, that I didn't think I was ever going to be able to buy with the way that prices were increasing. Well, now that one is down 15%. That one is down 20%. So it's no longer 900,000. Now it's 750. Now it's $700,000. Well, let me go ahead and just take my $40,000 loss because I'm getting a $200,000 gain on everything's on paper on the other side of things. So they're able to make that decision because they're upgrading and they're getting a higher price discount on the upgrade. And that's certainly a part of people's rationale. I'm going to add a fifth category. When this is all done, there's going to be 15 categories. I would say this. We have to acknowledge this. We have to acknowledge that there's a certain delusion when it comes to selling a home. There's a mindset that happens not only with sellers, but with agents, where it's going to return to normal. And it's going to return to normal like really fast, like within a matter of weeks or months, or there might be a really good week, or there might be a positive month. And like, you see, I told you so, without realizing that as the market trails down, you are still bound by cycles going down. Spring tends to sell with a higher price as opposed to fall, as opposed to winter. So, but if you look at the trend, you have to compare May to May, March to March. And then you have to look at the pattern in the trend. We tend to have really good early spring here in the Austin market. We tend to have really decent November and December within the Austin market. So it's really tempting for sellers or people in the industry to have this return to normal mindset while that appreciation keeps on chipping away. So those are the different categories. Very good question. Does this help with the question? Very good question. Okay, good stuff. Let's start updating. We currently have within the 6-county area 14,681 active listings currently in the market. Let's take a look at how many new listings have come on the market so far this month. We are looking at 2,332 new listings already. This is only the 12th of the month, and we're already at 2,332 new listings. Price decreases at 298. Price increases at 298. Price decreases at 2703. That number drops a little bit, 90%. I'll take that. Let's take a look at back on the market. We are at 306. There's that 13%. We are repeating that 13% back on the market from last month. That's going to be the lowest back on the market going all the way back to 2003. Very low back on the market. Active under contract so far this month. Oh, wow. Oh, oh, 748. Oh, wow. Okay. So, okay. Pending. It's May 12th. I need to drink some coffee. I'm having more coffee. 463. 463 pending. We're just about halfway through the month, and we've got a 0.46 ratio. Let's go to sold. So far this month, we are at 693. Let's go to withdrawn. So far this month, we have 305. And let's take a look at expired, 116. 0.46 ratio, it means that we're going to be right around that 0.6 to 0.62. That puts us within that substantial light, tangible plus increase in inventory. That means that the ratio between properties that are coming on the market and properties that are being absorbed by the market, we've got 38% less properties being absorbed by the market in relation to properties that are entering the market. That means that inventory goes up. That's what that means. It'll always mean this. We've been tracking this since January of 2000. This ratio is proven. I love how simple it is. It is what it is, and that's the fact. We can continue to expect an increase in inventory over the foreseeable future, with a ratio hovering right around that 0.6 into the 0.75. The really big difference is it going to be a substantial increase in inventory? That's going to be the 0.5 to 0.65, or a tangible increase in inventory between the 0.65 to the 0.75, 0.8. The lines are blurred between those transitions, but that's what that means. So far this month, a 0.46 ratio is very much in the cooler side of things, because the rate of new listings entering the market's pretty amazing. And we saw that by looking at the weekly year-over-year comparison. I'm still encountering multiple offer situations in Cedar Park, Round Rock, Bushy Creek, very active markets. Absolutely. There's always going to be recession-proof markets. Real estate's always going to be hyper-local. But I do want to remind you that one of the things that we have to look at is the year-to-date along with the year-over-year increase in inventory. Every area gets affected. Just like a high tide lifts all boats, well, you know what? A sinking tide will also affect all boats. And you can see the 78739 zip code as that classic example. You're going to be shocked when you see what's happened with the 78739 zip code when you look at months inventory year over year and then year to date. And that's something that we need to be aware of. But that doesn't mean that you're not going to have situations in very desirable areas where, yeah, you're absolutely going to have multiple offers. Keep in mind, you all, that when you look at the percentage of properties that sold over list price, the worst month on record on the percentage of properties that sold over list price was really recently. It was like a year or 2 years ago. We're going to go to Insight and Statistics. We're going to go to sold to list price ratio. I'm going to make this just a little bit bigger so that you can see all this information. Let me make this just a little bit. Oh, where's the icon? There should be an icon that allows me to kind of to pop this out. Did Google disable that icon? I sure hope they didn't disable. Remember how there used to be like a little icon right here that we were able to pop this out? Oh, well, I'm going to have to add a link that says download PDF, but there used to be a little icon that we were able to pop this out. Maybe Google disabled that. I'll take a look at it. But let's take a look at the percentage of properties that sold over list price. And we can see right here that the absolute worst month on record was December of 2023. December 2023, not too long ago, less than 2 years ago, was the worst month on record for the percentage of properties that sold over list price. It was worse than any time between 2008 and 2012. The second worst month on record was at 9.6%, October of 2011. So December of 2023 was worse than October of 2011 on the percentage of properties that sold over list price, and yet it was 9%. And yet it was 9%, which means, let's take a look at how many properties. And we can even go back up here. And we've got 2023. There's that 9%. 2,324 properties sold December 2023. That means that 9% of those, so you've got 200 properties. In the worst month on record for the percentage of properties that sold over list price, which usually signifies multiple offers. In the worst one in 25 years. So there's I promise you, if I were to go back, and I could even do this, if I were to go back and analyze those 200 properties, they would be in pockets. They would be in the 3.9, in the 78613, in the 78717, in the 78664. Like they would be in those little pockets, in really what we call the recession-proof pockets. And you can even take a look at the zip code analysis and you can see, well, where does my specific zip code rank as the percentage sold to list price ratio? And you can see that, let's keep on going because we've got charts that will give us all this information. You can see that the city of Austin, just look at the trend right there. We had Percentage of property that sold over list price. April, 16.8% of properties in Austin sold over list price. Look at how many record months we had that were fairly recently. And then you go on the zip code side of things, 2-1, 50%, just insane. We've got 2-5, 33%. We've got 3-3, 50%. Really incredible when you look at this. So there are areas that are always going to be like that recession-proof, doing very, very well. Look at Round Rock. All of them. We've got 25% sold over list price, 78681, 11.1, 18.2. That's a very good point that you bring up, Mike, and that is why we look at the macro data, what is happening at the 50,000 foot level, what are the articles going to be written about, and then we say, well, what's happening with my city? Am I doing business in Georgetown, Leander, Liberty Hill, Round Rock, Cedar Park, Maine, or Elgin? And then what's happening within my school district, my elementary, my middle school? What's happening within my neighborhood? What's happening within the section of my neighborhood? And then what's happening with my floor plan? This unique property with this unique floor plan, with this unique lot design. Does it have a backyard? No backyard. Does it have a corner lot? No corner lot. And then you add all of those together, and then you can analyze that individual property, that individual unique property, and make a recommendation for your client. Let's go ahead and keep on updating this information. And you can see that on the pending side of things, you all, we have been down double digits now for the past few weeks. And of course, on the monthly side of it, we are also down. Let's do a daily real estate briefing. This is where we consolidate out of the 2,000 and plus pages of reports that we publish and update on a daily basis. What I've done is I've captured the top reports. We merge all of this together early in the morning, and we update this Austin Daily Real Estate Briefing. I want to remind you that you can find the Austin Daily Real Estate Briefing by going to teamprice.com, scroll here, and you can see right there, Daily Market Snapshot, Austin Daily Real Estate Briefing. You can also take a look at the insight and statistics, in-depth single-page reports or individual reports on market stats, and then, of course, market trends for the top 30 cities, top 75 zip codes. And you can access this daily briefing right here and take a look at everything. And we do have that PDF download button right there. When you click on the PDF download, you can see the entire report. That's how you access that entire report. So let's take a look at this daily briefing, and let's take a look at all of these reports. This is where we consolidate everything. And we're going to start with active residential inventory. And what do you notice right there? Record high. Record high. Yeah, we do have a beautiful table of contents right there. For those who love table of contents, there you have it. Record high, you all. We are currently at 16,616 active listings currently on the market. That is going to be an increase of 183 listings from the previous record high that was only Friday, May 9th, at 16,433. Last year, we reached a peak inventory July 15th at 15,503. And you can see that we have crossed that record high, and we keep on beating that record high this year a lot earlier. Almost like the weather, because I don't know about you, but when I saw the forecast for Tuesday and Wednesday, I almost cried. And if you have not seen the weather forecast for Tuesday and Wednesday in the Austin area, then take a look at it and just shed a tear with me. So just like we are about to experience a record high early in the season, we are experiencing the same thing for real estate. 16,616. You can see that out of the 16,616, a staggering 49.5% of those have had a price drop. And let's take a look at the top cities with the most price drops and then the cities with the least price drop. And you can see Cedar Park doing very well with 43.3% of the 249 active listings on the market with a price drop. The city with the least number of price drops is going to be Smithville at only 36.4. We've got 43. That's going to be the second best, followed by the third best, which is going to be Cedar Creek. So Cedar Park is doing very well. The cities with the most price drops, you're looking at Manchac at 73.7%, which is just amazing. And then you've got Liberty Hill at 58.1, 56.3 Taylor, 56.6 Lago Vista. And you can see that we have 20.7% more inventory year over year compared to last year. Now, all we can do is draw a line because you can see that the market peaked right here in July. 2 years ago, the market peaked in October. We have no idea when this market is going to peak. But if we simply draw a straight line from where we are to when the market peaks, I'm going to run out of real estate screen. We could very well be looking at a 19,000 active listing market if we have the same peak in July. We could very well be looking at that. Now, could the market all of a sudden peak early and just start turning itself around and just kind of do one of these? Well, even if it does that, we could very well hit the 18,000 mark on inventory, which is going to be substantially more than this time last year. We can see that the number of new listings, the cumulative number of new listings that have entered the market, we're at 21,413 new listings have entered the market between January and May. The reason why this number is 7% lower is because we're only on May 12th. And for last year, we're capturing all of May, whereas for this year, we're capturing from May 1st all the way through May 12th. That's why we're trailing the cumulative, but it's only by 7%. I do expect that we are going to make up that gap and that we will have a record cumulative new listing when this is all said and done as we continue to revisit this information. What about pendings? We are trailing pendings by 0.5%. This exact same day last year, we had 5,014 pendings, and right now we have 4,989. And you can see that the cumulative pending, so the cumulative number of new listings were down by 7%, but the cumulative number of pending listings were down by 20.9%. So there's a 13% gap between the difference on the new listings and the pending listings. And of course, we knew that was going to happen because of the new listing to pending ratio being at the 0.44, 0.45, a very low ratio. That means we're going to have less pendings in relation to last year and more active listings that are entering the market, and of course in relation to last year. And this is all going to put pressure on the activity index, which is another favorite leading market indicator of ours. That is where we take the pending, we divide it by the active plus the pending. 25% is going to give you that 4.5, 5 months of inventory on the neutral side of things. Anything under 25% is going to point you towards more of a buyer's market, a softening market. Anything over that 35 to 40% is going to point you towards a seller's market. We're at 23.1% right now. We are down 13.5% compared to last year. And Mike, to your point earlier, take a look at the cities that are still doing very well and then the cities that are just getting ravaged. The cities that are doing very well, we've got Manchac, Kyle, Buda, Hutto, Jarrow, Maynard, Del Valley, Cedar Park, Lockhart, Round Rock. All of them are above not only the average, but the median activity index for the entire area. They're all above 25%. We've got two cities right there over 34% activity index. Kyle at a very solid 34.4% activity index. primarily driven by new construction offering amazing incentives to buyers in the form of rate cuts, rate buy downs, closing cost contribution, and price drops. And then you've got on the opposite side of the scale, you've got cities that are just, I mean, you just can't give the sucker away. You've got Spicewood at a very, very nothing happening 8.3 activity index, which is unbelievably low. That means that product is simply not moving. And you can see right now that at a 0.44 new listing to pending ratio for the month, I do expect this ratio to improve as more agents update their pending listings. But it's the lowest one on record. There's no way around it. I mean, we've got 0.44, and you're not going to find... We've got one other 0.44, which is January of 2004, but otherwise it's going to be the lowest one on record. I do expect it to go up, but I expect it to be right around the 0.60. And even at a 0.60 is still going to be the lowest one going all the way back to May of 2010, where we had a 0.52. That's for the month of May. We did have June of 2022, a 0.58. That's when the market absolutely stalled. The market peaked May of 2022. That's when prices peaked with the median sold price at $550,000. Of course, since then, it is down by quite a bit. But we saw that new listings enter the market, pendings hit a wall, and the same thing is happening right now in May with a 0.44 ratio. This is where we get the difference between new listings and pending listings. We track all of the cumulative, everything from January all the way through May. We take a look at everything that's new in the market, everything that's pending, and then we simply calculate the difference. The cumulative difference from January all the way through May for this year is at 5,301. And you can see that that's going to be the highest one on record going all the way back to 2004. And let's keep on looking at months of inventory. We are at 5.95 for the 6-county area. We looked at inventory for the entire MLS. We'll do another brief review on that. But right now we're at 5.95 months of inventory for the 6-county area. That's going to be an increase of 23.9. And the 4 cities with the highest inventory is going to be Dale, Lago Vista, Marble Falls, and Spicewood, all at over 11 months of inventory. And then the cities with the best months of inventory, you've got Hutto, Del Valley, Cedar Park, Round Rock, Pflugerville, Buda, Manor, less than 5 months of inventory. Now, let's go back to your point, Mike, which was a super valid point and something that we really need to understand about the market. It's not only what cities are still experiencing a very substantial demand for real estate, but is it going to change? Are we going to see pressure on pricing and demand based on the level of activity? And take a look at which cities are going up in inventory, which cities are going down in inventory. And take a look at Marble Falls. Marble Falls, year to date, this is going to be the right chart. We are up 120.7%. Year to date, from January to now, inventory went up from 4.98 to over 11 months of inventory. Cedar Park, that's the 78613 zip code. So even though we're still noticing multiple offers in Cedar Park, we're still noticing, 13.3% of properties sold over list price this past month. But look at inventory. That skyrocketed 109%. Not in 1 year. In 5 months. When you take a look at the year over year, Cedar Park is up 91.5%. And the point that I'm trying to make is that even though this is a lagging indicator, what happens 2 months from now when all of a sudden it's at 6 months? Well, then prices go down. And then all of a sudden you're like, wow, we're not getting multiple offers anymore. Well, it's a benefit to the buyers because if you have a buyer that missed out on a few multiple offers, they could very well have the ability to get something that they really like, they really want come July, August, September timeframe. Well, the risk for the seller is that with this rate of increase in inventory, that listing agent, that seller could blink and it be September. And it's like, I should have taken that offer back in May. That offer back in May that we were negotiating, we were off by $5,000. Now I'm getting an offer that's $20,000 less than that one. So realize the rate of increase in inventory. That is why we provide this tracking for inventory showing you what's happened over the past 12 months. Also want to remind you that this information is available for all 75 zip codes. If you go to Insight and Statistics, you go to months of inventory, here's the zip code information, and you can grab all of the zip code data going all the way back. You can look at the 12-month trailing, and then you can also see the zip codes that have experienced the highest rate of increase. And I mentioned 78739 on purpose because take a look at the year-to-date percentage increase in inventory for the 78739 zip code. A mind-numbing 291.4%. So when you look at the 3.77 months of inventory, it's super encouraging. It's like, well, yeah, still in a seller's market. That's great. That's awesome. Number one of the top zip codes in the entire area, 78739, super desirable. Only 3.77 months of inventory. And then you're like, whoa, that's a 291.4% increase year to date. Like, that is crazy. That is amazing. Does that mean that it's going to be 9 months of inventory in 5 months? No, by all means, it does not mean that. It simply means that we need to be hyper aware of the rate of increase in inventory. Could it very well end up being a 5.5 to 6? Yes, absolutely, it could be that. But that's why we track this information, and you can go here and take a look at the 78739 zip code, and you can see that a vast majority of the rate of increase in inventory was when? Over the past 2 months. So something happened. Something happened in that zip code 2 months ago that all of a sudden it just kind of hit a wall. We went from 0.96 to 3.77 in a 120-day period. We went from 2 to 3.77 in a 45-day period. So if I'm a listing agent in the 78739 zip code, I need to be aware of that because inventory is increasing. The rate of increase is absolutely exponential. It's really amazing. And that is happening in other zip codes around that area. And it's really something that we need to be on the lookout for. You take a 3.9, you take a look at 4.1, 4.5, a lot of zip codes year over year, a lot of it, you're on the positive by quite a bit. That's where you access that resource. Let's keep on going. The forecasted number of sold properties for this month at 2,566. That's going to put the cumulative number of sold properties from January to May at 11,516. We are forecasting a 12.3% decrease on the cumulative number of sold properties from January to May compared to last year. When we adjust it by population, that's going to be 453 sold properties per 100,000 people. When we adjust it by the number of realtors, 1,000 realtors, we take every realtor that's ever existed from January of 2000 in the Austin area, and then we adjust the number of sold properties based on the number of realtors. We are forecasting 620 sold properties. Cumulative, all sold properties from January to May per 1,000 realtors, 620. We are forecasting an 8.6% decrease year over year, and we are forecasting a slower pace than 2023. And the only other year that we had a lower number is going to be 2009. So based on everything that's currently under contract, based on everything that is currently selling, that is going to be a very accurate forecast. And when I say forecast, we're simply forecasting the month of May. If you look at this figure, we did not have 2,566 property sales so far this month. We take the number of properties that sold from May 1st all the way through May 12th, and then we extrapolate that number for the rest of the year. And then we add some adjustments based on seasonality of real estate, how many properties are going pending, and the fact that more properties closed in the last 15 days of the month compared to the first 15 days of the month, we add all that together and we come up with a forecast, and it's been very accurate over the years. Now, of course, with all of this happening, of course, prices are going up. Why wouldn't prices go up? Not only are prices going up, but prices are going up at just a crazy high number for the month of May. We've had very, very expensive homes sell so far in the month of May. It is a bifurcated market. The upper 25th percentile is not only holding firm, but it's doing quite well, especially when you look at the raw price. The price per foot, we're noticing some pressure within the price per foot on the 25th percentile compared to last year. But on the actual raw price, it's doing really, really well. But we are so far right now for all the properties that closed for the month of May, we are at $656,407, up 11.6% month over month, up 10.5% year over year. On the median, we're at $485,000. We're up $35,000 month over month, up $30,000 year over year. But take a look at that sold to list price ratio, way under last month. So what does that tell me? I do expect these numbers to go down, but we tend to have really good Mays. Mays tend to be more on the positive side of things, especially with pricing. But we're just going to have to wait and see how the end of May plays out. But some really expensive properties sold so far in the first 12 days of May. We do have a question about the top percentile. Do we have that info for the entire MLS combined or just broken down by city and zip code? That's a very good question. That's going to be page number 31 on the high-low chart, page 31 on the Austin Daily Briefing. And you can see there's the all right there. So we've got the all, and then we've got the individual city, and then we also have the individual zip code. And there's what I mentioned right there. So we've got a 0.2. So I love this percentile analysis. This is my favorite chart out of just about any chart. We take the bottom 25th percentile, meaning out of all the properties that sold, what is that bottom 25th percentile? The 25% least expensive properties. And where's that dollar amount? That means that in 2025, 2,649 properties over the past 30 days closed. That same time period in 2024, it was 34,000 or 3,415. So we've had a drop of activity of 22.4%. In 2024, the bottom 25th percentile, that price point was $345,000. In 2025 is $331,000. So the bottom 25th percentile is down 3.8% on price, 3.3% on price per foot. But look at the upper 25th percentile. That is actually up 0.2%. Now, do you notice how we were up both on the price and the price per foot? Now we're up only on the price. We're down on the price per foot. And if you go back and you listen to the archive, what did I say? That's temporary. Both of those numbers are going to go negative. Once those numbers go negative, you can expect the average sold price in the median sold price at the macro level, which is list level right here. You can expect that all of a sudden to start going down. When is that going to happen? Into June, July, August, September. It's part of that whole cyclical market. That's where you've got May tends to be peak of the market. And then you go into the fall and you have the bottom of the market. This line is going to go down. It's going to settle somewhere around the 450. And then we're going to enter the fall and the winter season where prices tend to lag the spring. They will always lag the spring. But when you look at the drop from peak, we are on the average, we're only down by $26,000 because so far we've got that insane 10.5% year over year price increase. Take a look at what's happened. Just went up like crazy. This line is going to go down. Last month it actually went negative. This line is going to go down. And on the median sold price, we are down by 11.82%. So far, year over year, we are up 6.6%. I also do forecast that that is going to go down. Too early to tell if it's still going to be on the positive side of things. Too early to tell, but this is not going to end the month at 6.6%. Best case scenario, it'll end on the 1%. Worst case scenario, it'll be negative 1%. That's going to be the range that I am comfortable giving you. So far this year, we are positive on the average sold price when you look at everything that has sold for the entire year. And we are negative on the median sold price when we look at absolutely everything that has sold. And you all, when you look at the median sold price using our appreciation chart, 12 out of the 30 cities that we track have actually gone up in price year over year. 18 have gone down in price. Some cities that have gone up by quite a bit, you've got Burnett up a staggering 21.8%. That's going to be the number one. That's going to be the best performing city. The least performing city is going to be, let's take a look at it right here. Let's take a look at number 30. Number 30 is going to be Burnett at a drop of 20.1%. Do you think the market will pick up some when school gets out? Here's me hoping. New construction is blowing my mind. Let me take a look at a few things. I've got a few things over chat. Do you think the market will pick up some when school gets out? New construction is blowing the lower percentile out of the water. Do I think the market will pick up some when school is out? What do you mean by pick up some? Like more activity, more pendings, more listings? Like, what do you mean by that? Pick up some. Oh, for some reason I can't hear you. I think Zoom. Yeah. Let me try to. I'm gonna have to try to adjust this once again. Zoom keeps kind of messing this up for some reason. All right, try that again. All right, you're gonna have to try that again. Yeah, for some reason I can't hear you. That just happens all the time after the weekend. I don't know what's going on. I will figure this out. Let me kind of click on. Yeah, Zoom won't even let me just get the audio settings up for some reason. So let me read it over chat. More people to buy homes. Well, I would say this. If you look at, this is where rates are going to be very important. This is a very important week when it comes to rates. The reason why is because this week we have CPI, Consumer Price Index. Now, this is going to be a very challenging week for rates because we have, look at the stock market, just doing absolutely crazy, just doing really well. We started off the day really high on yields because of the tariff news that came out over the weekend. That's improved a little bit. We're holding steady on rates. We're at 6.875 when it comes to rates. We're not noticing an increase today quite yet, but this is a huge week when you think about rates because all of the inflationary data that's going to come out this week is going to be backwards. Right? It's going to be rear looking as opposed to forward looking. So it really doesn't matter all of these tariff news. It's like, oh, wow, we've got all these, China dropped their tariffs and the U.S. dropped their tariffs and everything's going to be great. Well, this data is going to report what happened in April and it could be horrible. You could have like crazy sky high inflation. The month over month, the forecast is 0.3. It could come in at 0.5. And that's going to say, well, there's no way the Fed can cut rates. Why would the Fed cut rates when we've got crazy high inflation? Well, in that case, you can expect rates to go up. And if rates go up, and let's just say we go into the 7 1/8, it's going to just crush demand. People are just like, oh, not doing it. Like, not going to even apply for a mortgage. Now, if it comes in better than expected, they're expecting CPI month over month to come in at 0.3. Let's just say it comes in at, flat 0. Well, at that point, why would the Fed not consider lowering rates, right? If the inflationary numbers come in better than expected, and it did 2 weeks ago, why would they not consider lowering rates? So let's just say that they come in and they're like, hey, all of our inflation numbers are actually coming in better than expected. So we're going to go ahead and lower rates. Y'all, of course, it's absolutely going to affect demand. It's going to boost confidence. Hopefully, it'll then lower mortgage rates and people will see value in real estate. Absolutely, it will affect demand. So that's why this week is so important, so critical. Now, I will say this. There are some numbers that have never, under any circumstance, let me down, ever. Like, I have to trust the numbers. I have to trust it. You know, one of the things I love about, what about employment? Yeah, same thing with employment. We had better than expected employment numbers, 2 weeks ago, better than expected employment numbers. So if the private sector continues to employ, well, how is that going to affect it? People feel confident. People feel like, okay, I can make long-term buying decisions. So, but what if we have worse than expected employment? What if all of a sudden all of the tariff stuff that happened meant that truckers were laid off and dock workers were laid off and there's no one to offload container ships in all these ports and it has the trickle-down effect and unemployment goes up? Well, then, of course, confidence is going to go down. All of that is going to go down. And this is all at the macro level, and people do make decisions at the macro level. But there are a few numbers that have absolutely never let me down that I have to trust no matter what. You know, one of the things I love about Florida grocery stores, has anyone here been into Florida like a lot? Like you've been to Publix, you've been to Winn-Dixie? Not a lot of Piggly Wiggly in, Central Florida. Like, who here has been to Central Florida like a lot? Winn-Dixie, Publix, and all that. What is something that every grocery store has in Florida as soon as you walk in? I love it. I love it. Y'all know what I'm talking about? What's something every grocery store has this? You walk in and they have it in every grocery store. Probably an umbrella. No, not an umbrella. I'll give you 3 guesses. No. So every Publix store in Winn-Dixie and all that, they have an old school, like really cool old school scale. It's awesome. Right next to the front door. I love it. It's so cool. You just like one of those like really nice old traditional weight scale, like the cool ones, right? The ones you just like zoop, you just see the needle go all the way up. And it's just awesome. It's like one of those like nostalgia things, like really cool. And you see a bunch of people, like just, I'd say 1 out of every 5 people that is entering the grocery store just steps on the scale. There's like a little line forms, if you got a lot of people entering the store at the same time. And I love it. I just graduated high school out of Florida and it's so awesome. I always go back. We go back every year and I just love just hopping on the scale. And the scale, and I love it how it's right there in front of the grocery store. Like, it's great. It's like, hey, by the way, before you load up your car with a bunch of garbage, like, go ahead and just weigh yourself. And the scale has never let me down. It doesn't matter how I feel. It doesn't matter what I'm thinking. No, it's what that number says. I'm going to trust what that number says. I could feel great, but that scale might say otherwise. I could feel terrible. That scale might say otherwise. And we have these scales that we've created for the real estate market. And it's never let me down. Ever. The new listing to pending ratio has never let me down. The activity index has never let me down, regardless of the headlines. Another one that's never let me down is this inventory stress index. It's never let me down. That is why back in 2022, when the market hadn't even peaked yet, it wouldn't have peaked until May of 2022. What did I say? What did I go on record telling everyone? What did I start January of 2022 with? I started January 2022 with market like you're in a recession. Things are slowing down. And y'all, the amount of flack that I got for saying that. Dan, but prices are still up, but this is up, but that is up. You don't understand. Okay, sounds good. But why were we able to make such a bold prediction? Oh, it wasn't a prediction at all. because we noticed that there was a lot of stress within inventory. The rate of stress decreased, right? Meaning the higher the stress number, the more stressed the inventory is, meaning the more demand exists for that inventory. The higher the number, the higher the stress, the hotter the market. And then we saw that it's like, okay, we are now trailing the previous year and we are down dramatically. Like that number's down. And we noticed that starting when? Starting August of 2021. It's like, wait a second, we are trailing the previous year. This is not the same as last year. We have way less stress on inventory. And then we rolled into the new year and it's like things are changing dramatically. And that's why we were able to make that prediction. Well, so how does that apply to the question? Do I think that things are going to get better? Do I think that there's going to be, what was the exact question? Let me get the exact question. Do you think the market will pick up some when school gets out? The market could improve by a factor of 3 and it'd be like 2023. Based on the demand to inventory ratio. Like just let that sink in, right? We're at 5.3%. And that favors buyers. Like that favors buyers at a crazy high scale. Like that really favors buyers. Lowest reading going all the way back to 2011. So even if that improves by a factor of 2, that would put us in 2024. That would put us the same exact as last year. And that's if there's like a dramatic improvement almost overnight. What usually happens is that this ratio tends to continue to go down and it tends to be at its lowest in the fourth quarter of the year. So the fact that we went from a 7.6 in March to a 5.3 in April, that means that we really hit a wall between March and April. That's some pain right there. That's a lot of inventory increase in relation to demand. So I would say, and I would want that number to go up to the 10 to the 11, but in the context of multi-decade, going back 15 years, that's still going to be a lower demand. What we're not going to see for years is a return to the 20s, to the low 20s. That right there will take 2-3 years for that to happen. And what we have to notice, and what I like about this right here, this inventory stress index, this is an 18-month leading indicator. We can forecast 18 months out using this. That's why we were able to say back in 2022, hey, things are really slowing down. Like, you better market like you're in a recession, even though that didn't happen until 18 months later. And I will call the real estate correction in Austin as like a very, very deep correction, very deep correction. But we were able to, and we sounded like we were idiots by saying that at the time, but the data showed us that that's going to happen. Now, you know what will happen is the inverse. When I see this number all of a sudden going up by a factor of 2, all of a sudden it's like, whoa, we're at 20. And if that were to happen all of a sudden, I'll be the first one to tell you, y'all, it's getting hot in here. Like, it's going to get really hot. We were able to say that, back in 2022. Remember June of 2022 when the narrative was, oh my goodness, the pandemic is going to crash real estate. You can go all the way back and watch the recordings. What did we say? Hey, we said this back in May. I have a video in May with fire behind me of 2020 of me saying you're going to experience the single hottest real estate market the world has ever seen. Back in 2020. Well, why were we able to make such a confident prediction? Because of this ratio. Right? It's like we went from 13 to 22. It's like, whoa, what's going on? All of a sudden, demand in relation to inventory is absolutely on fire. And we're like, hey, the market's going to get crazy hot, you all. It's going to get really, really hot. And even though that's not what the headline said. The headline said that real estate market was going to crash. It's like, well, no, it's not going to crash. Look at the data. So if you were asking, do you think that things are going to improve? I would say that you have to divorce your business to the market. Like you have to do that emotionally, mentally, you have to do that. You have to divorce your improvement with the market's improvement. And you have to say, and I know many of you do this, and I'm unbelievably proud of you all. Like my dad just pulled numbers and he sent me numbers for last year compared to this year in the absolute incredible difference in y'all's productivity. And y'all, I mean, absolutely insane. We are looking at, let me see if I can find this. So we're looking at 117% increase. 117% increase. Like unbelievable. Just absolutely incredible. Unbelievably proud of you all. So this is where we divorce our personal experience with the overall market, and we're aware of the overall market because we need to equip our clients. We need to understand, but we need to say, I could care less if the market is going to be like this for the next 18 months. I'm going to have a record year. Like I will have a 20% increase, a 25% increase in my productivity, in my production, even if the market has a 50% decrease. Like I don't care. I need to understand what's happening, but if anything, it is fuel to the fire. If anything, it'll help me stay more focused. If anything, it's going to say, not only am I going to thrive in this market, but this is it. Like I'm going to grab my unfair share. That is the only mindset that can survive anything. It's just, I'm going to get my unfair share. But we're going to experience this for the foreseeable future, measured in multiple months, if not multiple years. I am convinced of that. Let me look at a few more questions right here, and then we're going to call it a day. It seems like a lot of cities are working on their own domain. Round Rock with the district, Cedar Park with the Indio Ridge, Pflugerville with Pecan Street. Do these big projects typically disrupt the market regarding activity? No, these are multi-decade projects, whether it's Northline and Leander, that's not going to be fully completed until 2040. And there's money. What it'll do, a very good question. In times of economic slowdown where capital becomes more expensive and companies want to hold back on major development and major money, is that they really want to do their due diligence to make sure that the project is they're going to be able to get tenants, right? The developer is developing the property and then they're going to get long-term tenants to rent out that commercial space. And oftentimes they'll go out there and they're like, all right, I'm about to build this 25,000 square foot multi-use flex space. Who's going to rent this? Hey, Trader Joe's, Sprouts. And what they want to do is they want to get an anchor tenant first. They want to get a really good big player, a Trader Joe's, a Sprouts, or, if you come here, then ancillary providers are going to come. If a Target comes, then you're going to have Crumble cookies. You're going to have a Longhorn Steakhouse. You're going to have, they tend to follow each other. So what you will notice is a little bit of a slowdown in announcements of major anchor tenants because they are doing their due diligence. They're doing traffic patterns, survey patterns, how many people they're doing their, what's the income of the people around the area, what's the closest place that they can shop. And then if all those numbers line up, they'll move forward. And then as soon as you get your big anchor tenant, then it's a domino effect. Then the smaller tenants will come in. So you will notice a slowdown in the pace of development. So instead of getting an anchor tenant to commit like immediately, it might be 12 months. And the same thing happened with the domain. If you look at Arbor Walk, this is where the Home Depot is. You know what? Y'all know where Arbor Walk is? Arbor Walk is south of the domain. When you look at Arbor Walk, this entire area, do y'all know what used to be here? I used to go here 2-3 times a week. You know what used to be here? Y'all remember? A driving range. It was a driving range. And I used to go to the driving range right here after work. Just hit 150, 200 balls. It used to be great. And this whole area in the domain, when was the domain developed, announced? 2005 into 2006, and then into 2012. But when the 2006 through 2008 recession happened, a bunch of projects were paused. This entire newer section of the domain, this was halted for years and years and years. Of course, now we look at it and we're like, well, no, it's 2025. They just built all that at once. No. I mean, there were moments where you would walk up and down the domain and a bunch of stores were just still boarded up because they couldn't get tenants. So the same thing's going to happen to these other projects. There's going to be a little bit of a slowdown. Once they get those anchor tenants, it'll just take off. These are 25, 30, 35-year projects. It'll be fine. Thank you all so much for joining. Super appreciate it. I will send you this video later on today. If you have any questions, let me know. Here to help. Otherwise, have an excellent rest of your day. And I will chat with you on Wednesday for our broker Q&A, contract review, and also training. Hope you have a great day. Once again, if you have any questions, let me know. Here to help. I will chat with you later.